Okay, let's unpack this because I think if you've spent any time looking at charts, especially in the crypto space, you hit a wall.
Oh, for sure.
You realize that just knowing volatility exists, well, it isn't actually helpful, is it?
Not at all. It's like knowing a storm is coming, but having no idea if it's a hurricane or just, a stiff breeze.
Exactly. The charts feel like they're written in invisible ink because you desperately need that directional insight. Is the market driven by, like, real anxiety or just irrational euphoria?
Right.
So today, we're cutting through all that static with a deep dive into crypto options skew, and we're going to use a surprisingly powerful way to think about it, the umbrellas and sunglasses strategy.
It's a great model.
This dive is all about reading market emotion, not just market movement.
It is. And this framework is so essential because options pricing, especially in a market like Bitcoin or Ethereum, it's just a pure reflection of our collective psychological bias. So we're going to imagine ourselves as a savvy vendor on let's say, a very temperamental beach. And we only sell two things.
The two core items that really define the options market.
Exactly. Our umbrellas, those represent put options. They're your protection against the rain or, a market crash.
Protection from that catastrophic downside.
And the cost of that umbrella tells you how likely the crowd thinks a drop is and how severe it might be.
Got it. And the other item?
Are sunglasses. Those are the call options. That's the gear you need to comfortably enjoy a massive uptrend, the blinding sunshine of a huge rally.
Okay, so umbrellas for rain, sunglasses for sun.
Now, skew. Skew is simply the price gap between these two items. It's the metric that tells us instantly whether the market is paying more for downside protection or for upside speculation.
So skew isn't just a number, it's the instantaneous emotional weather forecast.
That's the perfect way to put it.
If the market is absolutely terrified of a storm, those puts, the umbrellas, they become wildly expensive, even if the storm hasn't even hit yet.
Precisely. The mechanism is pure supply and demand, and it's all driven by fear and greed. If the collective market thinks a massive crash is way more likely than a massive rally, they will bid up the price of that protection.
And that price increases the premium.
Exactly. And it's the difference in premium between those two products, the put and the call, that defines the skew. It tells you which item is fundamentally overpriced based on what the market is feeling.
Now, this sounds a little bit like general volatility or implied volatility. Why do we need skew? I mean, if IV is high, we know the market is pricing in a big move. Why can't we just stop there?
That's a critical question.
Huh.
And it's really the difference between being a good amateur and a strategic professional. Knowing general volatility is just knowing the weather will be intense.
Okay.
A major movement is expected, say a 10% swing in either direction. But that knowledge it's directionally useless.
I remember looking at Bitcoin last year, and I'd see this massive IV, but I had no idea if I should be buying puts for protection or calls for the upside. It felt like a coin flip, just with massive intensity.
What's fascinating here is how skew completely transforms that coin flip. Skew is the structural tilt in that implied volatility. So if the IV of the out-of-the-money puts is significantly higher than the IV of out-of-the-money calls, we have a clear negative skew.
Which is what we're calling an umbrella premium.
Yes, and technically it's known as the implied volatility smirk or smile.
A smirk. So the implied volatility isn't a flat line across all the possible strike prices. It's actually a curve. And the skew is telling us how tilted that curve is.
Exactly right. When we talk about a high skew, we're really talking about a sharply tilted IV curve. The market is pricing in way more uncertainty and charging a higher premium specifically for massive downside moves compared to massive upside moves.
Nice.
Before skew, traders were just watching intense movement without knowing if that movement was fueled by a market-wide fear of a hurricane or just a mild heat wave. Skew reveals that directional bias.
So, to put it simply, volatility is the magnitude of the potential move, but skew is the market's perceived directionality of the really big risks. The minute you see a high skew, you know the crowd is paying a lot more for insurance than for lottery tickets.
Which leads us immediately to the strategic question. If the market is consistently paying a high premium for insurance, is that insurance actually worth the price, or is it just an emotional overreaction? That's where the money is made.
And here's where it gets really interesting, because we have a concrete data point from our sources that just illustrates this panic pricing perfectly. We saw this emotional forecast play out dramatically back on March 28th. According to the data, Bitcoin's one-week skew hit a massive 14.33%.
Wow.
And Ethereum's wasn't far behind either. It hit 12.85%.
Those are not trivial numbers,
Yeah.
especially crypto. I mean, for context, many established asset classes, like major stock indices, they might have a structural skew of maybe 3% to 5%.
Because big institutions are always demanding some level of put protection.
Always. Crypto historically often has a higher structural skew anyway, maybe 5% to 10%, which just reflects its inherent instability. But hitting 14.33%, that means umbrellas weren't just expensive, they were outrageously priced.
That level of elevation above the normal range signals extreme
Yeah.
directional anxiety. The market was basically screaming, we are more afraid of a 10% drop next week than we are excited about a 10% rally.
Precisely. The fear was fully priced into the protection. So if you were that savvy options vendor on the beach watching that 14.33% skew, you immediately recognize a psychological inefficiency.
Umbrellas, the puts are overpriced because everyone's afraid.
And sunglasses, the calls, are relatively cheap because no one is allocating capital to bullish speculation. The market is projecting a storm so aggressively that it creates this massive imbalance.
Okay, I see the inefficiency. But how do you actually execute on that? If I see umbrellas are overpriced, how do I strategically monetize that anxiety without, taking on infinite risk?
So the resulting strategy has to be disciplined, and it capitalizes on the market's overreaction. When umbrellas are clearly overpriced, the disciplined move is to sell protection.
Okay.
This means you sell the put option, and you collect that really high premium from all the fearful buyers.
Yeah.
You're basically acting as the insurance underwriter, and you pocket the fee.
And since the premium is so high because of that elevated skew, you get paid more handsomely for taking on that risk.
Exactly. You're betting that the market's fear is overblown, that the storm they're pricing in will either not happen or it won't be as severe as the premium suggests.
And what about the other side?
Simultaneously, because the market is ignoring the upside, the sunglasses, the calls, are cheap.
Yeah.
So you buy sunshine. You purchase call options, which are undervalued because the emotional forecast is only focused on the downside.
So the tactical move is something like a risk reversal or a collar strategy. You're structuring it to sell the expensive high skew put side and then buy the cheap low skew call side.
Yes, you're leveraging the directional bias created by emotion. You are monetizing the skew. But the guiding principle, whether you're selling a naked put or a put spread, it stays simple. Don't be the person buying sunglasses in a hurricane.
Right.
But also, don't overpay for an umbrella that everyone else is scrambling for. You have to check the emotional forecast, the skew, before you make any trade.
This moves us from just a quick tactical arbitrage to a much broader discussion about strategic positioning. Skew allows you to capitalize on market psychology, which feels like a far more durable advantage than just chasing technical patterns alone.
It does. It shifts your entire perception of how to manage capital.
It lets you move away from the noise and look at the structural fear and greed driving these option prices.
Which brings us to the deeper context provided in the source material.
So what does this all mean, then, beyond just options trading tactics? The sources suggest this strategic application of skew aligns perfectly with the mindset of successful long-term investors, what the source actually calls the millionaire mindset.
Yeah.
It's about shifting from being a reactive weather watcher to someone who's actually positioned for the changing climate.
And if we connect this to the bigger picture, it makes perfect sense. The wealthy don't chase every small storm or every little ray of sunshine. They focus on disciplined, strategic positioning.
And they apply specific habits.
They do. And those habits translate directly into how we should be using skew. The first one is they build habits. In trading, this means you develop processes, like checking the directional skew before every single allocation decision, rather than just reacting to the spot price or some headline.
So the habit isn't just trading, the habit is the disciplined analysis of that sentiment imbalance.
Precisely. Second, they protect their reputation. In a capital context, that means protecting your capital, ensuring disciplined risk management. If you are selling that expensive put protection during high skew, you must use tight position sizing and defined risk structures, like selling vertical spreads.
You have to make sure that if the crash actually happens, you're not wiped out.
You don't let a momentary profit opportunity compromise your long-term capital preservation.
That discipline, it's the ultimate antidote to the collective panic that creates the high skew in the first place. You're waiting for the market to give you the gift of an overpriced product.
And finally, they act with urgency and discipline. Urgency means when that skew anomaly is obvious, that 14.33% we saw, You move quickly to capitalize on that temporary imbalance.
But the discipline ensures you don't over-leverage or overstay your welcome once the skew starts to normalize.
Right.
This totally transforms the use of skew. It's no longer just a predictive tool. It becomes the disciplined habit that ensures you're selling high on market emotion and buying low on perceived speculation.
It confirms where the crowd is panicking, which allows you to take the opposite, more disciplined side of that trade structure.
And you're essentially monetizing the structural anxiety of the market.
You are. And for a market like crypto, which has this persistent structural negative, skew meaning puts are almost always a little more expensive than calls. This gives savvy players a consistent edge when they're allocating capital.
So this has been a deeply informative look into how market emotion translates directly into a quantifiable opportunity. The core lesson for you listening is this. Volatility tells you that things are intense. But skew, the price difference between the umbrellas and the sunglasses, that provides the critical directional insight.
The emotional forecast.
The emotional forecast of structural fear versus hype. Understanding this distinction and applying disciplined habits to it. Well, that's the difference between being a reactive trader who just watches the rain and a strategic positioner who profitably underwrites the market's panic.
And that strategic positioning leads us to a final thought to ponder. We've established that crypto often has a high, persistent negative skew. The market is consistently willing to pay a hefty premium for downside protection.
The umbrellas are almost always expensive.
Exactly. So if fear is structurally expensive in Bitcoin and Ethereum, what does that persistent anxiety reveal about the underlying institutional trust, or, lack thereof, in the long-term stability of this asset class? Should your strategic positioning, regardless of short-term rallies, perpetually prioritize deep risk mitigation and capital preservation? Should you always be selling that expensive insurance, even when the forecast looks sunny?
It's a question of discipline versus desire.
And the market is constantly giving you the answer in its pricing structure.